Hey everyone, welcome back to the channel. So in today's video, I'm going to share 9 dividend stocks that pay me a few $1,000s a month. Now, keep in mind, this is something that has taken me a pretty long time to build up. So when I first started investing into dividend stocks, I was making a couple dollars per year. And then over time, I was able to build it up after probably almost 10 years now. So I want to share in this video some of the stocks that are in that dividend portfolio. Of course, as always, this is not financial advice. I'm just a guy on the internet sharing my portfolio with you and some of the reasoning for why I have some of these dividend stocks in my investment portfolio. So let's go ahead and get started with this. If you're new here to the channel and you want to see more videos like this, don't forget to subscribe. And then, of course, if you want to get started investing, you can check out Moomoo, which is offering up to 17 free stocks at the moment. It's a pretty great deal when you sign up for an investment account through that platform. So I'll leave a link down below in the description for you to go and sign up for them. So let's start off here and let's talk about kind of what changed in the dividend portfolio, because last year I made a video about this, sharing some of the 7 stocks that were in my portfolio. Now, a couple things happened. I ended up selling ExxonMobil. I rode that up pretty well, and I felt like at the time today, I feel like even though energy has a decent future in the next few years, I still thought there might be some better opportunity. So I ended up selling Exxon, taking a nice profit on that, and of course, still pays a great dividend, have nothing really against it. I just think there might be better opportunities. Sold my PPL, sold some others as well. So let's talk about these 9 different stocks. The first one, and I actually added this one very recently, like last week, is Home Depot stock. So Home Depot, if you're not familiar with it in the US, it is a company that is really focused in the home improvement area. I think this is a sector that is really difficult to disrupt. You don't really have like Amazon or some of these online retailers disrupting lumber sales and a lot of home improvement things, because a lot of people who are buying from them are working on big projects. They want to go in person, pick it up with their truck. I really like Home Depot. Right now, they're paying a pretty solid dividend. So right now, Home Depot is trading at around $295. It certainly has had a pretty great run up over the past 10 years. Whenever I see companies that have really been moving quite a bit, sometimes I get a little bit concerned, worried that maybe the stock might be overvalued. But then when you actually look at their fundamentals and you look at how much cash Home Depot is pulling in and the amount of cash that they're just flowing every single quarter, it does feel pretty good. So right now, Home Depot stock is paying $2.09 in a quarterly dividend. Of course, this can change depending on if their profit margins maybe get a bit thinner, then they might have to lower this dividend. But I think overall, they do have a pretty solid chance of keeping that up. So $2.09 per share per quarter. So if you had 100 shares of Home Depot stock, you would be getting about $800 in dividends per year from Home Depot. If you had 1 share, you'd be getting about $2.09 per quarter times 4 would be a bit over $8 per year in essentially passive income for owning a stock like this. Now, let's talk about the next company that's in my portfolio, and this one is also one that I actually bought relatively recently. So this is Norfolk Southern Corporation. So this is in the railway industry, which, you know, I said this last year because I made a video and one of my dividend stocks were Union Pacific, which is also another rail company in the United States. And I had a lot of people reach out to me and say, Nate, why would you invest into a railroad company? This feels like the 1800s. It doesn't make very much sense. But when you actually look at how much money's coming in the door, once again, for a company like Norfolk Southern, they're pumping billions of dollars profit per year. And so the reason why I bought this recently is because there was a big incident recently where now the stock has dropped about 14% in the past month. There was a bit of a derailment. There were some issues. But I think that overall, this is going to end up being a buying opportunity for a company like Norfolk Southern. And this is why I entered into it. Now, they have a PE of about 15. Their dividend's paying about 2.5%. I think it's like 2.44% as a total dividend yield. So I think it's a good position to be in right now. They're certainly going to get sued. They're going to have some other issues, I think. But as the stock comes down, I'm going to start buying more because it's the rail industry. People have to understand how important railways are in the United States. They are transporting so many goods, different things that you can't just throw in the back of a tractor trailer and drive it across the country. We need the rail industry for so many different categories. And we're not building any more of them, right? And so they can continue to increase prices. So I think it's overall one that I'm happy to have in my portfolio for the long term. So the next company that I have in my portfolio. And by the way, I just want to make this clear that of these 9 stocks, they're not in any particular order. Some of these are larger, some of these are smaller positions. I'm just going to keep those a bit private. So the third stock in my portfolio is Air Products. Now, I mentioned them last year because this does make up a decent amount in my portfolio. So Air Products and Chemicals, this is a company that is actually based in Pennsylvania. This is why I'm familiar with them. I've known this company for my entire life. But right now they're paying a 2.5% yield on their dividend. So it's about $1.75 per quarter. Average that out over a full year, and that comes out to about $7 per year in annual dividends that you'd be getting from a company like this. Now, there's a lot of reasons why I like Air Products. Of course, the number one thing I always look at with dividend stocks is their ability to pay out, right, and make sure that they can sustain that dividend. And Air Products has paid a dividend for as long as I can remember, my entire life, and because they've always been very profitable as a company. About 10 years ago, I think it was 10 years ago, they had a new CEO come in. I know Bill Ackman was involved, and they kind of tried to turn around the company, and they actually did, and it worked out pretty well. They sold off a lot of their chemical division, and right now they're so focused on some really key industries that I think are underserved, and they don't have a lot of competitors. There's really 2 other big competitors in the world besides Air Products, which is Airgas and Linde, which is German. But I think Air Products leaning really heavy into the hydrogen sector is going to pay off big for them. And the other good thing about a company like this is they are extremely diversified. So even during something like with all of this inflation that we've had over the past year, Air Products really does have some pretty great pricing power, and they're able to pass most of the price increases onto their customers, which is just in their contracts. So overall, it's a company that has really treated me well for the entire time that I've held this stock. They're at a $62 billion market cap. I think they have room to grow, and they're also, I would say, semi-recession proof. Of course, if we see big drops in like industrial demand, then yes, Air Products is probably going to get hit a bit. But if you look at their core customers, a lot of these end up being a lot of other industrial uses, right? A lot of oil and gas companies, or even governments and different projects that I think are going to be used regardless of whether consumer consumption declines a bit or not during this upcoming recession. So overall, I do like the company. It has been pretty steady. And since I had it in my portfolio last year when I made the video, I think it's up about 13 to 14% since I talked about it last year. So not only have I been getting a 2 to 3% dividend on that, but it's also increased in value over the past year. So I do like this company quite a bit. Now let's talk about the next dividend stock in my portfolio, which is one that I did add this year very recently. So a new addition to my portfolio this year was Barrick Gold. Now, I try not to have too many miners in my portfolio, but I do think that this is another area that has been overall underinvested into. And, I don't want to go on rants about the mining industry, but I think overall it has been pretty underinvested into, especially in the past, really since we had the last commodities boom and then bust in like 2012, 2013. We saw this massive drop off in investments into this category. So Barrick Gold, I don't actually own this for the dividend. I kind of just view it as the cherry on top here. I actually own it just for other reasons, so I think the stock's going to go up, but of course, this is not advice. But right now they're paying 10 cents per share as a dividend. You have to be careful with a company like this because they might end up cutting this. Like last quarter, it was 15 cents per share. Now it's 10 cents per share. So I'm getting 40 cents per share as a dividend, which I don't know the math on that, but it comes out to probably about 3% annual dividend that I'm getting from this company. And this right now actually does make up a big portion of my dividend portfolio. But as I said, I'm not really counting on it long term because they might end up cutting that. If gold prices go down and they're not as profitable as they once were, they're going to cut that. They actually have the terms on their site, which I find very helpful on their investor relations site, where you can see kind of their game plan of whether they're going to raise or decrease their dividend based on how much money they're pulling in. But it is one that certainly does pay me quite a bit quarterly, so I had to include it in this video. So the next one that I added into my portfolio recently was Realty Income. income. As we saw kind of real estate sell off a bit last year, I realized that, I don't think we're going to see like a 2007 housing crash like what we did previously in the last recession. And I think a lot of people are reading it wrong and they're expecting like to have a big credit bubble again and like the big short, right? I don't think that's going to play out. I think banks have been a lot more stringent on who they're giving loans to. And so that's why I invested into Realty Income. This is one of the biggest REITs out there. REITs do act a little bit different, and you could argue that it's technically not a dividend, but I wanted to include it in this video because it is providing me with a level of passive income. So right now it's averaging out to about 4.64% as a dividend annually, but the total payment is 76 cents per quarter. So multiply that by 4, and that comes out to about $3.04 per year per share that I'm getting on this for owning Realty Income. So Realty Income, this is a real estate investment trust. Look, they own so many different units in the United States, in Spain, in the UK. A lot of them are actually triple net leases, so they do a lot of corporate leases as well. So I think overall it's pretty stable. I mean, of course, look, if you go back and you look at REITs and what happened to them back in 2008, they did pretty bad. And some of them went under, some of them just totally collapsed. So there is risk with this, but along with that, you are getting a higher yield on your money as well. So weighing the risks, for me right now, it feels like it's worth it to have it in my portfolio, but for you, maybe not. It really does depend on a lot of things. Now, one thing before we get into the next ones, I want to remind you that you got to be careful chasing dividend yields, and anything really over like a 5 or 6% dividend yield annually should be a bit of a red flag. It doesn't mean that the stock's going to be a bad stock long term, but if a company's paying like 10% dividend yield or 20%, be careful, because in a lot of cases it's not sustainable, right? And so just make sure you do your due diligence there. And that's why like a 4.64 is pretty good, but if it starts getting higher and it's like 8 or 9 or 10%, I start to be a little bit more wary and really dig into it deeper to make sure that that payment is sustainable. So the next company that I added into my dividend portfolio, this one's very interesting, and this is actually Altria. So Altria is a tobacco company, which I've had different thoughts on whether or not I should add this to my portfolio, but watching what happened with when they acquired a large portion of Juul and then had to basically write off that entire investment, and they basically had to write off billions of dollars. When they made that announcement, Altria got hit pretty hard, and their stock price went down to the very low 40s, like $41, $42 a share, which is when I picked it up. And so the reason why I like this company as an investment is because the dividend yield is very attractive and I believe to be pretty sustainable and stable as a dividend. So it's yielding about 8%. And what I do with this stock, so it's 94 cents per quarter, which comes out to just under $4 per year, and it's only a $47 stock, right? So if you had 1,000 shares of this, you could be getting about $4,000 per year for owning this stock, just under $4,000, right? But what I do with this one, this is a lot different because I'm not a long-term believer in something like the tobacco industry, but they're pumping so much cash that what I do is I take the money from this dividend stock, all the payments, and I take that money, instead of reinvesting it back into the company, I invest it into other dividend stocks. Most of my dividend stocks in my portfolio, I will reinvest those dividends back in so I can buy more shares through the dividend reinvestment program that my broker allows me to do. But with Altria, I don't think this company is going to be like long-term over 30 years going to be doing extremely well. And so that's why I'm just extracting this money and I'm putting it elsewhere. But we'll see how long I end up holding it. I mean, I've done really deep dives into the tobacco industry. And if you have done that as well, you'll know that there's no competition. There's basically no other competition is allowed and very much stable, quite a bit of pricing power. So yeah, that's one of the stocks that I have in my portfolio. It's a pretty small position, but it does pay a pretty solid dividend. So the other stock that I still have in my portfolio from last year when I made that video where I shared my portfolio is JP Morgan. So I love JP Morgan. I think it is the best bank out of all of the different financial institutions in the world. I actually just got finished reading a massive book on the House of Morgan, really fascinating. But I think Jamie Dimon is a great CEO. Right now they're paying $1 per share per quarter, so it comes out to $4 per year, and the dividend yield is about 2.91%. So last year when I mentioned this stock, I think it was around 150 some dollars per share. So it has actually gone down. And even including the dividend payments that I've gotten, you could probably say that I probably have lost money on JP Morgan over the past 12 months. But that's okay because I really do feel as though this bank is the most stable bank out of all of them. If you look at their balance sheets, they have a lot of cash on the balance sheets. They have this really great, basically, financial fortress. They were the ones bailing people out in the financial crisis in 2008 when a lot of other banks were failing. JP Morgan was there. They were not failing. And I think that's for a reason. So there's two more dividend stocks that I have in my portfolio right now. One of them is PepsiCo. Look, this is a company that's been around for an extremely long time. I'm sure you already know what Pepsi does, but I like this for a couple of reasons. I think the biggest one is that they have great pricing power, and if you understand the beverage industry, there's not a lot of players. Anytime someone comes up with a new drink, like look at Logan Paul with this Prime sports drink, someone's going to buy it. It's either going to be Pepsi or it's going to be Coca-Cola. There's not really many other people who are going to buy it. So I think they have great pricing power. They're able to continue to push their higher prices onto consumers. We've seen that recently. They made those earnings announcements. They're paying a pretty decent dividend, $1.15 per quarter, which comes out to, what is that, $4.60 per year, which is a 2.61% dividend yield on this stock. And just look at the long-term results of PepsiCo. It's pretty stable. I mean, they've had some drops. They've had some issues back in 2007 when pretty much every company went down. They lost about 30% of their value. But other than that, I mean, this company has been pretty rock solid. That doesn't mean that they're not going to have any issues in the future, but I do like PepsiCo as a whole. And the last one that I want to share with you is actually not one specific stock, but it is an ETF. So the Vanguard High Dividend Yield ETF, the ticker for this is VYM. And I like this because it kind of takes away from me having to identify specific companies, and I'm kind of shifting into this more. I might continue to add to it and kind of decrease some of my other dividend holdings just so that I can be very passive with this. And right now, I think it's paying out about 3% annually in dividends. I'm not quite sure. I need to look that up. But it also has a very low expense ratio, which I find to be very great for an ETF. Always be careful on ETFs if you're paying high expense ratios. Really anything over like 0.5% is kind of ridiculous. That's why I like the Vanguard funds. So if you don't know which dividend stocks to buy, or maybe you're not good at analyzing stocks, then I would consider looking at something like one of these Vanguard high dividend ETFs. They also have some other dividend ETFs as well that you can look into. They have some REITs and some other REIT ETFs that you can look at as well. Of course, there's always going to be risk with everything, but I think overall that's one that I feel pretty safe with. So those are the dividend stocks that I have in my portfolio now at the moment. There's also Waste Management. I didn't mention them because 10 stocks would just be a weird title. I think 9 looks better, but I still like Waste Management. I've always had that company in my portfolio. So those are the main stocks that I have in my portfolio, in my dividend portfolio. Yes, it's paying out a few $1,000s per month on average, but it really does depend on the month. Some months it's going to be a lot more than that. Some months it's going to be less because every company pays out their dividend on a different day and on a different month. So it's provided me with a nice stable income. I think I can't retire now because inflation is running quite a bit, so that definitely is unfortunate. But hopefully we can make this video next year with an update, and it's my hopes that that dividends increase, of course, once again. So thank you for watching the video. I hope you found it valuable. Don't forget to get your up to 17 free stocks on Moomoo using the link below in the description. You can use those stocks to hopefully start buying more dividend stocks. So thanks for watching the video, and I'll see everybody in next week's video.